Hi, welcome to this podcast, final podcast that I'm going to do on budgets, and we're looking at flexible budgets. By and large, in exam questions, your flexible budget is going to be your income statement. You could do it in theory with other budgets, but it just tends to be the way that exam questions work. And obviously, the budgeted income statement that forms part of the master budget alongside a budgeted statement of financial position. Okay, we need to look at, therefore, think about the impact of increasing or decreasing output on different types of costs. Fixed costs, generally, they do not change. If you rent a 100 meter squared factory and you increase output slightly, the rent of that factory is going to stay the same. And similarly, if there's a small fall in output, then that won't change at all. It's possible, there's an argument that all fixed costs are to a degree semi-fixed costs. They don't tend to come up very often or at all. I've never seen them come up at all, to be honest, in one of these types of questions. But it would be conceivable that you do a level of output that does exceed the maximum capacity for a factory, in which case you may need to include an extra factory's rent in the fixed costs, but unlikely. Variable costs, obviously, they're pretty straightforward. They increase or decrease in direct proportion to the change in output of a business. So if we had a cost of raw materials of £1,000 and we doubled output, then we would have £2,000 worth of cost of raw materials. And similarly, if the output was halved, then the amount of cost of raw materials would drop from 1,000 to 500. Revenue, a bit like variable costs, increases or decreases in direct proportion to the level of output and therefore sales. And final costs that we may need to consider a bit more difficult are things like semi-variable costs. So in the example we're going to do together, we include a amount of commission that salespeople receive on their sales. So the basic salary would be the fixed part. That bit would not change regardless of the level of sales. But if we double the level of sales, the commission element would also double. So as an example here, we've got a firm provided the budget below for 1,000 units, and they wish to create a flex budget to calculate for 1,500 units. Staff wages include a 10% bonus based on sales, and purchases will increase directly with sales. So most of this is dead straightforward. You have a column for 1,000 units, create a second column, and potentially a third column in an exam question for, in this case, 1,500 units. The sales are going to be straightforward. We know that they get 20,000 in revenue for 1,000 units. So we will divide 20,000 by 1,000 to find out the revenue for 1 unit, then multiply that by 1,500, the total units we now expect to sell, and that gives us 30,000 as our sales revenue. Just do a similar calculation for the cost of sales as they increase in direct proportion. And we can now calculate our expected gross profit for sales of 1,500 units or 1,000, and there's an increase as we'd expect of 15,000. Rent will stay the same, that's a fixed cost, so we don't need to change the number for that. And then we get onto the slightly more tricky calculation that we need to do for the staff wages. So the first thing we need to do is to find out what the bonus was when we had 1,000 units being sold. And we know that's 10% of 20,000. So the bonus for the staff wages at 1,000 units of output was 2,000. And we know that the staff wages were 5,000, in this case, dollars. So 5,000 take away 2,000 gives me the fixed element of the staff wages. So at 1,000 units of output, the staff got a fixed wage of 3,000, and they also got a variable element, which is a bonus of 2,000. So what we can now do, we know that they are getting $2 per unit. $2,000 divided by 1,000 units gives 2. So we can work out what the bonus element would be at 1,500 units. 1,500 times 2 is $3,000. And therefore the total wage, if we sell 1,500 units, is going to be the bonus plus the fixed cost of 6, so in total $6,000. And then to calculate the profit expected at 1,500 units, we would subtract the total of the expenses from the gross profit, and that gives us a flexed budgeted profit of $4,000. A little bit of theory at the end, but as normal, I've done a question for my students to do and to share back with me. Okay, in terms of flexing, if you get a flex budget to do in your exam, you'll almost certainly be expected to write an essay on the benefits and disadvantages of flexing the budget. If we've got a number of flex budgets, what it does, it makes it easier to compare actual performance with the planned performance, because we can say, well, we almost sold 1,500 units and not 1,000 units. Do our actual costs reflect the costs in the flex budget? It then allows us more easily to create more realistic variances and to allow a firm to more quickly identify where there are problems within the firm. Judging performance against a flexed budget will be seen by staff as being fairer than having a single fixed budget at the start of the year and still comparing their performance regardless of the actual levels of output. It will also focus managers' minds on efficiency rather than just saying, well, there's been a change in output. We've sold 1,500 extra units. Therefore, I would expect my costs to be wrong, and therefore, I am not going to look at my costs now. It will focus them on looking at how they are doing against how they were expected to do for a level of output and sales. And it allows firms to think about optimizing their use of resources at different levels of output and sales. Disadvantages: takes time, so there's obviously a cost. Regardless of how many flex budgets we do, it's all based on estimates. So, for example, if my expected selling price is way out, my budget is never going to be accurate anyway. Similarly, if my purchase price of raw materials has been incorrect from the start of the budgeting process, then all my flex budgets might be significantly out anyway. And variances still need to be investigated. Indeed, we've already done standard costing and variances. There's an argument that really by doing this, we're just creating an extra stage anyway within the process. So we can flex variance calculation using other methods. We don't need to do this. Now, I'd counter argue that a little bit myself in terms of non-finance managers may not understand where flex variances come in using standard costing. So there is an advantage in being able to present to them a flex budget, explain where that comes from, and it's in a format that's easy to understand, and therefore you may well still get additional buy-in from doing this process. In evaluation, my experience, I've worked for 2 multinationals, and both of those use a form of flexed budgets. Maybe not quite, neither of them exactly in the same way that you get taught at A level, but nevertheless, it is something that happens, and therefore I think overall, most businesses seem to use it. Overall, you'd probably say it is a good thing. The advantages do outweigh the disadvantages. And I think the big thing is the fact that it is quite an easy format for managers to be able to look at and to understand what's caused the changes in the costs as we flex up or down a budget, and to keep them focused then on the areas which they can control quite easily. Right, thank you very much for your time and patience. Any questions from my students, give me an email me your work, and have a great day.